So the next topic right now is when to go out of small caps and mid caps, which is basically increasing cash on topping out patterns or on the way down. Now, this is a very interesting and an important topic because on the upside, small caps give you super normal returns. On the downside, they can give you super normal drawdowns also. And if you can get a strategy to get out of them or increase cash right at the top, it will give you a lot more confidence to trade small caps across the bull market all through your career. So that is where we look at it. There are two ways we look at topping out. One is getting on the way down, which is where we use Dow theory and simple technical principles. Second is where we look at divergences. So, and that is very, very interesting as well. But we'll start off first with the basic principles of Dow theory, higher tops and higher bottoms, how it can help you get out. So what we'll do is we'll take a look at the Nifty chart over the last few years and how it could have given you a very simple signal to get out. So this is a period of 2009 to 2013, a nice higher top and higher bottom being formed. You can use trend lines as well as a simple parameter of the last major swing bottom being broken. So out here, if you look at it at this point of time, the last two bottoms are broken. You have two tops which are lower, and this is where it breaks down. And out here, the trend line, the momentum trend line, which is nice higher tops and higher bottom, is also broken. So at this point of time, you know the trend has changed. This is the point of time you want to increase cash and start being very, very careful in small caps and start getting out, or not the best time to participate. Then the next one in 2013, this was the tough one. We got a breakdown of the last major swing lows as well as the trend line in 2013. It fell for 5% and then recovered back. But it remained sideways for the next 6 months. And post that you got another entry. But this was the toughest one in terms of a trap. So that is why we also specify the traps where you won't be right all the time. So you know you can go wrong as well, but you can't go terribly wrong taking an exit at such points. Then we look at 2016 to 17. Nice rally, higher tops and higher bottoms. This is where the last two major bottoms are being broken. One bottom made a swing back, then it breaks the same bottom. So clearly two lower tops and two lower bottoms. The trend has changed somewhere out here. And then there is a nice correction in this period. So this is the point of time you know you can't be aggressive. You want to increase cash. Or be very, very careful and start looking at leadership. So these are the times where you don't want to be aggressive. Same way going into 2016, this is a nice higher tops, higher bottom formation. Breaks the multiple bottoms here. This is before the demonetization event happened. We had already broken down on the Nifty, and then you get a good correction. And in this correction, we saw again small caps falling by 20-25%. Then the next one is we go a little far back, also back in 2005 to 2008, and see how you could have got out. So this is somewhere in 2008. The first bottom breaks out here in the first correction, makes a low, again makes a recovery. That bottom also breaks. So you get two signals from that 6400 mark. You get a signal at 5500 or at 4700. They may still look a little deep from the high of 6300, but the fact is after that 4700 mark also we went all the way to 2500 to 2200. So this was clearly a simple exit if you followed the principle. So either on the first one or on the second one you would have saved yourself. Then in 2020, again this was the nice uptrend which was going on from 2016. That broke out here, the last bottoms also broke. By 11,000 you would have known the trend has changed and you don't need to be aggressive. Now, so this is the simple criteria. We've looked at it in Dow theory as well. Now we look at a very interesting criteria which would be a little early signal. Selling on the way down requires a lot of skill set to be executing the logic you have. But on the way up, it is the other problem, which is where after you sell, you still have to see stocks going up and be able to digest it. So trying to get out at the right times, you'll have to take some pain on both the sides. So that is where we look at the BSE small cap and the Nifty divergence. Now, this is where I go to the a topic which I like, which is the BSE small cap index. Now, this is a superb index. I think this is a very unique index across the world. Because most of the indices, if you see across the world, what are they? Nifty 50, top 50 stocks. BSE Sensex 30, top 30 stocks. Dow 30, S&P 500, Nasdaq 100. If you look at all the indices across the world, it is always focused on the top 30, 50 names to give you an indication of the market. But the fact is there are always 2000 plus stocks in all the countries across the world generally. So which is an index which actually looks at the bottom category. So BSE small cap is a very superb index because if you look at other small cap index, it is again the small cap 100, the mid and small cap 250 or the mid cap 100. But BSE small cap is a very unique index. It is designed to represent the bottom 15% of the total market cap. So all the companies which come in the bottom 15%. So it does not have an upper cap on the number of companies. It could have 600 companies, it could have 850 companies. So we've seen it a lot of times have 850 companies. Now it has 850 bottom-most companies when the total listed universe is 2500 on BSE, 25, 2800 and 1500 to 1800 on NSE roughly on the best case. So it captures the bottom-most index. So it can be called as the Kachara index of India. And the fact is, you know how the Kachara is performing. So it gives you the best indications of euphoria as well as pessimism. So at one point of time, very recently, at almost 956 stocks at peak, right? Now, let us look at this index to understand both euphoria as well as pessimism. Now, by the structure of the index, what happens is, generally, a stock has to do really well to get into the Nifty 50. Out here, if the stock does really, really well, it gets out of the BSE small cap 100, BSE small cap. So it keeps on showing the Kachara all through the cycles. So it gives you the best indications. So what do we do for finding these divergences? So what we do is we map out the Nifty with the BSE small cap. Now what does euphoria mean is Nifty is doing okay, but the small cap is going crazy, right? This should not happen, right? What we say is Kachara is doing really well, Gode, Gade, sub stocks chal rahe. Whenever this scenario comes, you know there is this sort of uneasiness. But when you chart it out with a map, with a chart, it becomes easier to accept it. So let us look at this example in 2007. We've got a nice bull market which played out between 2003, 2004, 2005, all the way to 2007. Now this is the ending last 3-4 months of 2007. What do you see? The Nifty is struggling to make a move, but the small cap index has gone berserk. In this period of time, if you see the Nifty went up 5 to 8%, but the small cap index almost went up closer to 30%. So it was almost the 3x the move of the Nifty. So very simple criteria is in a short period of time, there is a X percentage move on the Nifty and there is a 3x percentage move on the small cap. It's something which is scary. Then what happened is this was the final leg and you know this will happen, it will make 2-3 tops. So you'll get the first indication, say Nifty is at 20,000, the small cap index is at 30,000. This goes to 20,500, the small cap index has gone to 33,000. Clearly this is up less than 5%, this has gone up 10%. It will make another top wherein 2,500 becomes 21,000 and this has 33 has become 36 now. So in that period it could last for months. But by the time the second top of divergence is made, you get that uneasy feeling that everything is blowing up. That is the point of time the distribution is at its peak and you want to increase cash. And be ready to accept that stocks will go up a little more. But that is the time you take your chips off the table. So this is what happened in 2007. Now let us look at the same case again a few years later. What happened? This is what happened somewhere in 2010. The Nifty is marginally making a new high, but you are making 3 to 4 higher tops on the BSE small cap. Clear cut outperformance of the BSE small cap, a clear cut divergence that created a major top. And every time such topping out formations happen, we've seen a 15 to 25% correction on the small cap index. Now all through 2015, you could see this lower tops on the Nifty, higher tops on BSE small cap, a good correction. Then again 3 lower tops on the Nifty, higher tops on the BSE small cap, again a good correction. Then the last one in this period, the Nifty has already corrected 10-15% and we are seeing the BSE small cap almost go back to new highs in 2015. So this was a very stark divergence and then it fell a good 25%. Same way going into demonetization, in 2016. You have 4 lower tops on the Nifty and 4 higher tops on the BSE small cap. Now imagine this, you have an event of US elections, demonetization was not in the picture. You have such a big event, but still what you are seeing is Nifty is struggling to go up, rather making lower tops. The BSE small cap index keeps on making higher tops. That clearly is a signal, boss, this is the time to increase cash, get out of small caps. If this was not enough, we saw this happen in 2017 and also. The Nifty is laboriously making that move at 10,500 to 11,000. But the BSE small cap index went on making 3-4 big highs. Now, this is what we looked at. I actually wrote an article back in 2017, how long can this continue? So what we've seen is this phases of outperformance in a big way, divergence in a big way, lasts somewhere between 2 to 8 weeks or maximum of 3 months. And after those 2-4 weeks where you see the outperformance, you'll get your signal that this is a huge divergence, you need to get out, stay away. The problem part is to take chips off the table, because when this is happening, everything is doing well and it is very tough. But the fact is, if you can increase, not just, I'm not telling you to sell the whole portfolio, if you can go from 10 to 40% cash, it can change your performance for the next few years. Because when you increase cash at the tops, the advantage is not just the fact that the markets have fallen, but the fact is when the markets fall and then they start recovering, new set of stocks do well. So for example, 2020 you increased cash, you had cash at the bottom of the cycle. Pre-2020, which were the companies which always did well? Banks. But what happened in 2020? IT, pharma and other leaders came in. So the cash which you have conserved goes into stocks which are taking leadership. So you get a double benefit of it. One, you've saved yourself the correction. Second, the money gets allocated to the right stocks, the new sectors. And this happens with every cycle. Say in 2007, if you increased cash, all the companies which were doing well were infra, real estate. And even if when the bottoming out happens and the reversal happens, there are different set of companies. But if you're still stuck in real estate and infra, even the whole market goes up, your portfolio will not go up because you were still stuck into the previous horses. So the double benefit of increasing cash is what? First, it gives you a lower drawdown to your portfolio. Second, your money goes into the right places, and that does much, much better than the market. So it gives you a double benefit. And then to sum it up, we use one nice ratio chart which we've seen has given a good indication of how the cycles play out. So what we do is we take a ratio chart of the BSE small cap and the Nifty. So basically it's a simple ratio. You divide the BSE small cap by the Nifty. What happens is, we've seen over the last 20 years roughly, whenever this is closer to 0.9 to 1.1, that is the point of time where you need to deploy cash, where the small cap has done terribly bad for a period of time, and closer to 1.8 to 2 is the point of time where it has outperformed in a big way, and that is the point of time you want to raise cash. This is what happened in 2010, 2008 as well as in 2018 on the upside. Then in 2009, 2013 as well as in 2019-20 we came to the lower end of it. So if you can do this calculation, and you don't even need a chart for it, you can just divide the BSE small cap and you'll get a good range. To look at right now, we are still at 1.6, 1.7, so this is, we are right in the middle. And mind you, it may look like a very small gap, but the fact is it has to have a huge performance. For example, the Nifty goes up 20%, the small cap goes up 20%, the ratio remains at the same place. So for this flip to happen, you'll have to see the small cap outperform by a big margin. Just going up is not going to change the ratio. Going up much, much higher than the Nifty is going to change the ratio. So these are the two parameters we look out, and the last one to give an indication. To sum it up, when do you want to increase cash? One strategy is on the way down, when we shift from higher tops to lower tops and lower bottoms. Second is the BSE small cap divergence with the Nifty. Very simple, BSE small cap making higher highs, Nifty being flat or making lower highs, or underperforming the BSE small cap by a big margin. Whenever you see that, get uneasy, start acting up, start increasing cash, and then sit on that cash. You'll get a much better opportunity in the next cycle to deploy into new leaders.